Political turbulence limits Latin America's economic prospects. Looking beyond the current election cycle, the governance problems that plague several Latin American countries are becoming an obstacle to investment. Latin America has surprised economic analysts for the better this year. In recent weeks, multilateral organizations such as the International Monetary Fund and the World Bank have improved their growth prospects for the regional gross domestic product, GDP, which is projected to reach 2%, well above what they anticipated at the beginning of the year. But a closer look at the forecasts shows that the impulse comes, mostly, from the two largest economies, Brazil and Mexico. The rest of the region is experiencing difficulties, and one of the biggest is the political situation. A report from the credit risk rating company Fitch, published last week, identifies political turbulence as a factor that increasingly limits public finances in Bolivia, Ecuador, Panama, Peru, Chile and Colombia. This transcends the current electoral cycle, which includes presidential elections in Argentina this weekend. The region's GDP growth forecasts for 2023 continue to be revised upwards over the past month, mainly thanks to recent better-than-expected data in Brazil and Mexico. Next year, Latin America's economic expansion will slow down and will be well below the world average, hampered by political instability and the region's limited presence in high-value-added industries. In terms of public finances, this has been a good year, Fitch noted in its report. Growth has been mixed elsewhere, with momentum in Central America fueled by remittances. Sluggishness in Andean countries amid policy tightening and political turbulence, and a drought-induced recession in Argentina. However, political challenges and instability continue to weigh on the ratings in most of Latin America, Fitch analysts warned. These issues have played a role in most of the downgrades and negative outlooks, specifically by clouding policy predictability, aggravating fiscal pressures and/or negatively affecting growth, the report noted about Bolivia, Ecuador, Panama and Peru. In Chile and Colombia, governance problems have already contributed to rating downgrades in recent years. The forecast for Argentina, the third largest economy in the region, is pessimistic. The economy will be affected by exchange controls, hyperinflation and rising interest rates, all monetary policy decisions. The drought has limited exports and economic activity. In Peru, the consensus is that GDP will grow at a significantly slower rate this year compared to last. Inflation and rising debt costs complicate the country's financial situation. Furthermore, a global environment weakened by wars in Ukraine and the Middle East will affect the external sector. Weather phenomena associated with El Niño and rising social unrest amid political uncertainty pose downside risks. For Chile, analysts see that the probability that citizens will reject a new constitution in the December referendum is increasing, complicating governance. While in Bolivia, President Luis Arce was expelled from his political party to choose former President Evo Morales as a candidate in the 2025 presidential elections. In both cases, political uncertainty could deter investment. www.gac.com.cy